And when they accelerated in Q1 of last year, many banks rushed to protect their liquidity by offering high rates such as 3, 4, or 5% on CDs, something that these depositors have not seen in a very long time. So by doing that, we have kind of woken up the depositors and they've become more aggressive in moving money from non-interest bearing accounts to interest paying accounts. Now, the deposit outflows did subside in the second half of the year as well, which was great news, considering what everybody was talking about at the start of the year when the banks failed, that there's going to be a massive deposit outflow and the banking industry is going to struggle a lot. But that did not happen. I think everything that the banks did, the regulators did, the government did, I think they were able to make sure that this does not happen, or this does not spread a lot. We do bake the deposit growth in our projections as well, but now that does come at a cost. We have seen asset yields climb for banks, but not as much as on the deposit side. And part of the reason is that the banks are not just competing with themselves, but they were also competing with the money markets and the treasuries. Another thing is what we look at is the deposit betas, which is the percentage of Fed funds that the banks have to pass on to the customers. That also increased very rapidly in 23, and it continues to do as the rates remain higher for longer. And again, the reason for that is the deposit mix shift, a lot of money moving from non-interest bearing accounts into higher interest paying accounts. In fact, for the 18 months ended September 30, 23, we had a staggering decline of 26% in non-interest bearing deposit across the banking industry. Now that leaves us into a place with margins under pressure, and that are pretty much reflective in the valuations. That is historically low as well. Another thing that is negatively impacting the valuations right now is credit. Good news is that we haven't seen any major cracks in the armor yet, but the investors don't quite believe it. And there are reasons for that. There are a handful of banks that have problems. We have seen delinquencies rise. The loss content's going to be high for sure, but that's not something that you're going to see that we saw in the 2007-2008 global financial crisis, which was a result of years of non-prudent lending. So we remain in the camp that it is going to be manageable. The hit to the income statement is going to be manageable. It is more of an earnings issue than a safety and soundness issue at this point. But definitely something that the regulators and investors are monitoring very closely. So with the pressures on margins and the credit costs causing a headwind to earnings, we believe that the banks are going to be pushed on to focusing more on efficiencies, which could spark M&A back to life in the second half of this year. And I'm going to admit, I've said this multiple times, I've been saying this since last year, that M&A activity is going to return. It was supposed to return in the first half of this year, but it did not. Part of the reason is obviously the rates have not gone down, but there's also additional regulations coming out, which is kind of delaying the processes, and the regulators are trying to make sure that they do not create a bigger problem in the long run by allowing a lot of bad banks to merge. All right, over the next couple of slides, I'm going to go over some data which is old, but it does give context to why the industry is struggling right now. This is data just before the three big banks failed last year. So Q4 22 data, and what you're looking at is the uninsured deposit concentration levels, the third column, and the outliers there. You can see Silicon Valley Bank, Signature Bank, and First Republic Bank with very high uninsured deposit concentration levels. Now, uninsured deposits in itself is not problematic as long as you have enough liquidity and your depositors are not going to flee the institution. But as soon as that happens, your liquidity comes under great pressure, and that is something that we saw with these banks that had unprecedented runs. Another takeaway is that if you are going to operate with such high levels of uninsured deposit concentration, you need to operate with more liquidity. And one of the ways we look at is the last column you see here, loans plus HTM securities to total deposits. And the idea there being deposits outpaced loans by $4.5 trillion in 2020 and 21. And what the banks did was they used that excess liquidity into building their HTM securities portfolios, essentially seeing them as loan surrogates. So this metric is basically looking at the duration risk or how much of your deposits are tied to less liquid assets. And again, you can see the outliers there. Silicon Valley Bank, Signature Bank, and First Republic Bank with 110.6%, compared to the industry aggregate of just 78%. Another piece of data just before the banks failed. To this point, the industry had said this is a liquidity issue, not a capital issue. And that is something that the regulators are also focusing on in the regulatory exams by looking at things that, like liquid assets to uninsured deposits. They're running some tabletop exercises, simulating a run on the bank, focusing on the deposit levels, the availability of cash for a bank. On the flip side, even though these banks were well capitalized, the fact that their securities were so deeply underwater, if they had to blow out their securities portfolio for a loss, they would have very little to no capital left. And this is looking at the fair value adjustments to the tangible common equity for the banks. And you can see a lot of these big regional banks struggling on that front. First Republic Bank actually had a negative TCE ratio, if you take marks. So you guys might be aware the HTM securities on your balance sheet are recorded at the book value, not at the fair value. Your available for sale securities are recorded at a fair value. But if you take those adjustments, if you mark the fair value adjustments on those HTM securities as well, they had very little capital left. Now, some of this pressure did ease up in the fourth quarter with the medium to long-term rates coming down. But at the start of 24, the rates went up again, and the securities remained deeply underwater. This is a stat that we recently looked at. So you're looking at banks below $250 billion in assets and the capital raised since 2021. And this chart kind of speaks to some of the concerns that the investors have out there. 45% of that capital went to the failed banks from last year. So that includes Silvergate, Signature, SVB, and First Republic Bank. Silvergate obviously had different issues. It was much smaller, and it was actually the bank that kind of kickstarted everything, but nobody really talks about it because we had much bigger failures after them. Just a week after, and that wasn't technically a failure. They voluntarily liquidated, and they had a lot of crypto-related issues. But 45% of capital going to failed banks speak to some of the concerns that the investors have out there. But you also want to make sure that you are not painting the entire industry with a broad brush. There are a handful of banks that have issues out there, but not the entire industry. There are over 4,000 banks in the country, and a lot of them are still doing good. Earnings are definitely under pressure, but when you look at safety and soundness, they're still doing pretty well, like I talked about. A lot of people expected massive deposit outflows from the banking industry, but that did not happen. We actually saw deposit growth return in the fourth quarter and the first quarter of this year. Moving on to some of the more recent data, looking at the balance sheet transformation over the last couple of years. On the asset side, you can see loan growth has been very slow. It's almost non-existent. First quarter of 24, we had a decline in loans. And the first quarter of last year, we had a decline as well. And between that, for the 3 quarters, each quarter, we had a loan growth of less than 1%. And a couple of reasons for that, obviously high interest rates and also the credit issues. So banks are tightening the lending standards. And another thing is that you want to have high returns on these loans, considering the high cost of funding these loans right now. If you look at total securities, we had a 6th consecutive quarter of decline in total securities. Obviously, as the interest rates went up, the value of these securities came down. A lot of banks started restructuring their securities portfolios. We did see an increase in the fourth quarter and the first quarter of 24, some banks investing in short-term securities. But I do want to mention that a lot of this data is skewed. So it is very important Now, right now, I'm looking at the industry aggregate data, but a lot of this data in Q4 and Q1 is coming from a handful of large banks making changes to their securities portfolios. So Bank of America, for instance, increasing their securities by $70 billion in the fourth quarter. So that really distorts the data. So you want to make sure when you're looking at industry trends, you're also diving into it and see where the results are coming from. If you look at the rest of the industry, we continue to see decline across the industry, excluding these big banks. A big spike in the orange bar here, cash and equivalents, which was a lot of banks holding on to cash after the bank failures to basically maintain the liquidity profiles. And moving on to the liability side of things, we had a 6th consecutive quarter of decline in non-broker deposits, which are the cheaper deposits. And almost all the growth had been coming from broker deposits, very expensive product. We finally see a decline in the first quarter of 24 in broker deposits, which is good news, but the concentration of broker deposits still remain very high. Again, a big spike in the orange bar there, total borrowings, which was, again, banks tapping into emergency programs like BTFP. A lot of that was just-in-case money to avoid bank runs. A lot of banks have since paid those down and since moved to slightly cheaper alternatives, such as broker deposits, which also kind of explains the massive growth in that bucket. With that, I'm going to take a break for any questions and also going to let Hunter talk about some of this data that I've shared.
Sure. Yeah, so as Zain was talking about, there's a lot of detailed available content on the banking sector, and we at S&P put it all together, create these aggregates. Show the Excel real quick here. Let's see. Actually, just come back to that later on. Cool. But yeah, we can see trends like the deposits fell pretty markedly last year for the banking sector as a whole, largely due to a couple of those bank failures. It's kind of small right now. I'm going to go on to the next one. But yeah, we can see that loans grew some quarter over quarter, but as a whole, very, very small, very flat on the last couple quarters for loans. Also hadn't really talked about, we can go back and forth there a second. Hadn't really talked about commercial real estate much in terms of the credit quality discussion, but there's a lot of investor interest around commercial real estate, particularly office loans, and in some cases there have been some concerns around industrial loans. And this is one illustration of the difference between these regional banks that have, I think, about a quarter of their portfolio in commercial real estate versus those total bank sector that's around 15%. Yeah, we can go on to the next one. Yeah, and then on loan composition, again, just saying that about the quarter. And then on the deposit side, as Zain was just saying, that share of non-interest-bearing deposits has been falling quarter over quarter for both those regional banks that, in this case, is the 10 to 100 billion, and then the sector as a whole. Banks have been having to rely more on CDs, broker deposits, high-cost products, which really compresses their margins. Let's see. Yeah, and then same thing here, non-interest bearing, about a quarter of the market, but it's fallen around 4% year over year.
All right, cool. This is the Federal Reserve's H8 weekly report that put out every Friday. This is more recent data, so we're looking into what has happened so far in the second quarter, midway through the second quarter. And you can see we continue to see pressure on lending. We have 23% increase in the second quarter so far. Securities continue to decline, and deposits actually declined in the second quarter. So we are now seeing some pressures in the second quarter. What are the different strategies that the banks are adopting to get more deposits? One is obviously that we talked about offering higher interest rates to their clients, customers. The other is different sort of bonuses for referrals, for new account openings. Every other day I'm getting a letter from JP as well, asking if I can list of savings account or checking account. So a lot of banks are doing that. Partnerships with digital banks, launched their own digital banks. And banking as a service is another thing that has come under spotlight over the last couple of years. A lot of troubles come with banking as a service as well. And we have seen a lot of enforcement actions from the regulators on certain banks that have those partnerships. So essentially, banks are basically good at relationship building and all that stuff, but when you need deposits to partner up with certain fintechs, which bring into technology, because they have expertise in that. But sometimes with these partnerships, they're not doing their due diligence, so bringing in deposits and loans from some of the high-risk customers, or your deposits may be priced very high or not, so you're not able to repay those deposits. So unless you have a very big risk management team or a compliance team, it is very difficult to have these partnerships and not have some sort of an enforcement action. Last year, 18.5% of all enforcement action against banks were due to these banks with these partnerships. And these are only the actions that were made public. Thank you. Were all the actions that were made public. There's a lot of discussion going in the background as well with these banks, so we're going to see a lot of those. I've talked to a few attorneys who talk about, like, there are a lot of banks that have these partnerships and the regulators are asking a lot of questions, but they're not making any public actions right now on these banks. Breaking the deposits down a little further, I talked about CDs, a very important product for banks, especially for smaller banks, community banks. They rely very heavily on CDs. The concentration of CDs has risen above pre-pandemic levels. It's close to 16% now, and it's the highest since the second quarter of 2013. So what happened was you had a massive influx of cheap deposits from pandemic that pushed your non-interest-bearing deposit concentration to as high as 28.9%. And since the Fed started raising rates, the concentration has fallen to 21.7%. You can see CDs concentration falling to below 7% in 2021, but has risen well above pre-pandemic levels with roughly $4 trillion more in deposits now. I'm going to take another break, and Hunter here can talk about some of our rates data in the product.
Sure. So, of course, we're all familiar with the earnings content, the GAAP financials for banks, but some of the information can be available on a more frequent basis, and investors tend to reward banks that are able to maintain lower cost deposit franchises, so they're able to keep deposits around without maybe getting quite as aggressive with the rates offered. So we collect weekly data. I'll just leave it on here for now. Weekly data showing the different deposit rates for a variety of standard products, based on company websites, et cetera, survey portal. So you could look and see to the banks and how much they've increased, say quarter over quarter, month over month, et cetera, in deposit rates. So for this example, I ran a search of banks that have branches in Virginia that are offering the highest one-year CD rates. So we could see, I'll go and switch to the Excel this time. I do have it up. But basically, only a handful of ones are offering over 5%, but quite a few banks here are going to be offering over a 4% rate. And again, we could sort this, pull it in Excel, et cetera. But the lesson here in a lot of cases is that the banks really have to fight harder for these deposits. And so the ones that are able to maintain those relationships without having to raise rates so much are going to be in a much more favorable earnings position.
Great. Hunter talked about it. One of the products that we look at when we're looking at deposit the one-year 10K CD product, and how many banks are offering rates above 4% on that product. As of the end of May, we had over 800 banks offering rate above 4%. And at the end of 22, we only had about 65 banks that were offering rate above 4%. So, and that number continues to go up. And the banks offering rates above 5%, you can see a big spike at the end of 23. We had a lot of banks offering rates above 5% as well. It dropped down sharply at the start of this year, but is starting to creep up again. So banks are still feeling the pressure on the deposit front, and they're still continuing to offer higher rates on these products. And that is part of the reason we continue to project higher cost of funds throughout the year for the banking industry as well, because even if the Fed pivots later in the year, you're going to have these products on your books for at least another year. So these banks have marked or offered these rates on a 1-year 10K CD that they're not going to be able to get rid of even if the Fed pivots. So your cost of funding is going to remain high for another year. And the reason why this data is so crucial, and Hunter mentioned that we collect this weekly, and it becomes more crucial when the Fed pivots, is to see who's going to move first. Are we going to cut with the Fed penny to penny? How much are we going to cut? Obviously, at one end, you have margins under pressure, cost of funds are high, you want to bring those down. But at the other end, you don't want to be the first one to cut and lose your customers across a shop, to a shop across the street. So you want to see who's going to move first. I think when the Fed starts moving, we're going to see a gradual decline in rates, just like we saw a gradual increase. On the securities front, obviously a lot has changed. A lot of restructuring, a lot of banks selling securities over the last few months or quarters. A lot of banks letting these securities run off the balance sheet. Some banks reinvested the proceeds into high-yielding short-term assets. Other banks used those proceeds to pay down higher-cost borrowings. What you're looking at here is the blue bars are the net unrealized gains or losses, and the orange bars are implied unrealized gains or losses in HTM securities. So while the higher rates did benefit some of the loan portfolios, you can see they completely hammered the securities portfolios as the losses in both of these buckets more than doubled since the first quarter of 22. Now, I talked about this earlier. There were some pressures that eased in the fourth quarter, but at the start of this year, we continued to see those pressures and securities remain deeply underwater. I also want to mention the fact that HTM securities now roughly make 48% of the total securities portfolio, and there has been a big mix shift in the securities as well. And a lot of that is coming from bigger banks. And why is that the case? Because your unrealized losses on HTM securities, they flow through the regulatory capital for the US G-SIBs. And it's going to impact other banks above 100 billion in total assets as well whenever the Basel III Endgame proposal goes through, which was pulled back because there was a lot of pushback. There was really big campaigns against the Basel III Endgame proposal. But in one way or another, in one form or another, we are going to see it go through, and it's going to have an impact on banks above 100 billion in total assets. We saw news a couple of days ago where it looks like the revised version that the Fed has pitched to the other two banking agencies looks very different, or it's going to have a significantly lower capital requirement for some of these larger banks. But for much of the industry, it's actually the tangible common equity. So your unrealized losses flow through the tangible common equity as well, and the regulators monitor that ratio very closely. If it falls below 5%, you're subject to greater scrutiny, and even more if it falls below 3%. And if your bank has a critically low tangible common equity ratio, you have limited access to capital, and you're subject to limitations on borrowings from the Federal Home Loan Banks. Now, moving on to some of our projections, we are going to put out our updated projections in a couple of weeks' time as well. So we do this every quarter. We have projections for the entire industry and for the community banks as well. What you're looking at here is the yellow line is showing the Fed funds, and the light blue line is showing the aggregate cost of deposits. So that's the all-in cost of deposits, not just interest-bearing cost of deposits. And the shaded region is the gap between the two. And you can see over the last few quarters, the gap has been so wide between the two, causing the deposit outflows. But the last couple of quarters, that gap has started to narrow down, and we continue to project that the gap will continue to narrow down, and we're going to start seeing deposit growth. And we expect a deposit growth of around 4% in 2024. Loan growth is going to remain weak, as I talked about, because of higher interest rates. One thing I do want to mention here is that a lot of these projections that we put out are based on the rate assumptions, the rate projections, macroeconomic data that I'm glad I don't have anything to do with. We have an economics team, IHS, They do that for us. And I've seen some of those projections change over the last couple of weeks, obviously because the rates continue to remain high. So we are going to continue to see higher cost of funds for a slightly longer period now. This is something that I recently looked at. The number of banks with a NIM, net interest margin, of 2% or less. You can see that number spiked quite a bit in 2023. In the first quarter of 24, we have 251 banks that have a NIM of 2% or less. And honestly, if you're a community bank, a small community bank with that level of NIM, you're not making a lot of money because you're not going to have a lot of other sources of non-interest income. Now, you do see a big spike in 2020 and 21 as well, but I would rather ignore those numbers because that data was skewed because of the pandemic stimulus. So you had like PPP loans, which were going into the average earning assets, which is the denominator for NIM, kind of dragging the NIM down for a lot of those banks. So I would ignore those numbers. And if you look at the most recent number, 251 banks, looking back historically, this is the highest number of banks with such NIM levels since 2009. So a lot of pressure on NIM that we haven't seen in a very long time. Lots going on this slide, so I'm going to try my best to explain this. Investors are definitely rewarding banks with a lower cost of deposits and a really good liquidity profile. On the x-axis, you see deposit beta, 3 different metrics, and the industry median for those metrics. On the y-axis, you have the median price to tangible book value. The orange bar is basically the price to tangible book value for the banks that reported a number higher than the industry median, and the blue bar is the price to tangible book value for the banks that reported a number lower than the industry median. So you can see the banks that reported a high deposit beta, which means a very high cost of funds, they are trading at lower price to tangible book value compared to the other banks. Same goes for loans plus HTM securities to total deposits, because those banks have a lot of their deposits tied to less liquid assets. But it's the opposite for non-interest-bearing deposit concentration, because the higher that ratio, the better it is. So you can see the banks that reported a number higher than the industry median, they're trading at higher multiples compared to the other banks. Any questions so far? I know I'm throwing out a lot of numbers here.
Can you talk about the syndicated bank loan market and the impact on banks, how much profit that adds, or how much competitive competition with the major proprietary bank loan market is?
The lending market overall is very slow. I haven't looked at syndicated bank market, but I can definitely talk to you more about it after the presentation about this. I'm not an expert. I haven't pulled that data a lot. But generally, the entire loan market is facing a very fierce competition because of higher rates and the credit quality issues that everybody is experiencing. So it's not just limited to the direct loans from the banks. It's basically impacting everything related to consumers right now. CRE, so talking about loans and credit quality, CRE is obviously a very big issue right now. It has been an issue since the pandemic. A lot of people moved to remote working jobs, a lot of empty office spaces, a lot of pressure on the office sector. So CRE was definitely under spotlight, but it's at the start of this year, it picked up again because of the New York Community Bank Corp news. So they had a very disappointing fourth quarter earnings where they created massive provisions and reserves for CRE, and a large chunk of their CRE portfolio is multifamily in a very highly rent-regulated area, New York, where the landlords are also kind of struggling because of the higher interest rates, not a lot of renovation going on, so a lot of weaknesses in their multifamily portfolio. On top of that, they had to take a goodwill impairment charge, so there was a very big investor reaction. The stock was falling, fell quite a bit. They have had a lot of changes at the exec level. They had, I think, an 8% deposit outflow in the first quarter, which is massive, but according to the new team, it's not as bad as it could have been. The good news is that they were also able to raise capital in this environment, so some of the investor confidence returning, that was good news. But we are going to see a lot of changes, and that bank in particular is going to remain under spotlight for at least a few more quarters. And one of the problems with that bank was also because how fast they grew. They had the Flagstar acquisition, and then they had an acquisition of a failed bank last year, which was also a red flag. But they have now crossed the 100 billion threshold, which requires them to comply with more capital requirements. So that is creating more pressures, and they're going to try and continue to shrink. They recently announced a 5 billion loan portfolio sale to JPM. CRE overall, which you're looking at on this slide, this is the CRE guidance that the three banking regulatory agencies put out in 2006. What this does is that if your CRE loans exceed 300% of your risk-based capital, and if they grew by more than 50% over the last 3 years, or if your construction and development loans exceed 100% of the risk-based capital, you're subject to more scrutiny. So the regulators basically, it does not automatically limit you from lending or have any other restrictions on the bank, or at least that was the case historically. So you're basically going to answer more questions from the regulators about what kind of CRE do you have? Is it more owner-occupied? Is it non-owner-occupied? Your risk management procedures, your capital levels. So you're basically going to have to answer more questions. Now, that was the case historically. What I have seen or I've been hearing over the last few weeks is the regulators are really taking this tool very seriously now, and something that they have started issuing to some of these banks they call IMCRs, individual minimum capital requirements, which is a non-public correspondence between the regulator and the bank, basically asking them to improve their capital levels. And one of the case study that one of the attorneys was presenting at a conference I was in, they had the construction loans were 250% of the risk-based capital. So definitely the flag was there, but apparently the bank was doing better. I don't know if the bank was doing good or not, because they were the attorney. They were saying it was good, but who knows? They cannot disclose the name. I don't know what bank that was. But they basically told that bank in that IMCR that if your ratio exceeds 400%, you have to increase your capital ratio to 15%. If it goes to 350%, you have to increase your capital ratio to 12%. The numbers might not be accurate, but this was the concept. And if it doesn't change, if it stays where it is right now, 250% of the risk-based capital, they still have to raise their leverage ratio from 8% to 9%. And they only gave them 30 days to do it, which is kind of a concern. Like you still have over 500 banks with this flag right now. That's a lot of banks. And if the regulators start doing this to a lot of banks, these banks are going to be focused on maintaining those capital requirements and not be able to benefit from high yields that are out there right now. So I understand that the regulators are trying to be one step ahead, and they are trying to make sure no other banks fail on their watch. But at some point, you're going to try and make sure that you're striking a balance between the regulation and also allowing these banks to breathe a little bit and be profitable, considering the margins and earnings are under pressure. I've talked to a couple of regulators as well, and they said, yes, they're doing IMCRs, but they're only doing it to banks that are bleeding, that are reporting losses quarter after quarter. And if that's the case, that's good news. But obviously, you don't want over-regulation in the time where the banks are already struggling. I'm going to take a break here again and have Hunter talk about some of the asset quality data.
Can I ask a question on that last slide? Obviously, the number that meet both criteria have come down here in the past 5 quarters. We've seen 4 bank failures over the past year plus. I guess my first question is: are those 4 bank failures in line with what you were thinking a year, 15 months ago? Were you expecting that? Were you expecting more bank failures just based on, kind of the risk level of where we were? Has that trended in line with your expectations? That's the first question. And then the second question is really kind of about the loans. Like, when's the maturity wall that these banks have, these commercial real estate and construction and development loans? When do these start maturing to where they're going to actually have to recognize the losses?
Okay, good question. All right, so first I'm going to answer what really wasn't a question, but you mentioned the trend, the number of banks is going down with these flags. And the fact that it's going down is because of these banks, a lot of these banks trying to get out of the spotlight from the regulators. So they don't want that additional regulation. So the number of banks falling down here is not necessarily a good news. It's basically because banks are trying to trim their CRE exposure. That also explains lack of loan growth. There's a lot of pressure from the regulators and investors as well. Coming back to your question, what we were expecting, we were definitely expecting a lot more failures. When the first 3 failures happened, part of the reason is how fast the fear was spreading across the markets and how fast the information travels right now. I was talking to somebody earlier today here, talking about when Silicon Valley Bank failed, nobody had ever talked about uninsured deposits before Silicon Valley Bank. But as soon as Silicon Valley Bank failed, everybody was talking about uninsured deposits. And a lot of those analysis out there were wrong. And they were creating panic. Because uninsured deposits in itself is not a problem. I talked about it. But it's how fast that information travels. And that was one of our biggest fears when we were putting our research out, is we're going to have a lot of bank failures because some banks are just going to be in the middle of a fire, even though they're doing good, but investors are just going to be fearful, there's going to be panic, and they're going to lose out. We saw a couple of other banks that had a very, very narrow escape. So PacWest was one of those that was struggling quite a lot. They were able to get into a deal with Bank of California. There was another one, Western Alliance Bancorp, that was struggling a lot. What they did right was, again, information. They were the only bank I saw throughout those 2-quarter period where they were disclosing a lot of information no other bank was disclosing in their SEC filings, the type of deposits they have, their deposit maturity, deposit broken down by industry. So they were under fire a lot, but now they're doing pretty well. The problem banks still going up, like I talked about it. I also don't want to downplay this a lot. There are issues. There are issues with CRE. There are issues with banks that have these weird partnerships going on with fintechs that are not doing their due diligence. So you are going to see bank failures this year. The problem banks in the FDIC's report, they're going up as well. So there are going to be failures, but I think the industry responded very well. I just kind of felt like a lot of people were talking about there are going to be a lot of failures, there's going to be a massive deposit outflow, but that did not happen. And talking about these loans, that's exactly what some of these banks are basically doing. They're waiting for these loans with low yields to mature and basically run off their books or be able to sell these loans. There are a lot of non-bank buyers out there right now, so a lot of banks are getting rid of their weak loan portfolios and handing them over to non-banks. So they are moving out of the industry and they are trying to tap into higher yielding loans.
So there were essentially just kind of bringing forward their losses at a more measured pace by selling the loans?
Losses on the loans, you mean? They're slowing the pace of that? Is that your question?
Well, I guess the way that I'm understanding it, we can take it offline.
Yeah, no, I mean, no, that's fine. That was a good question. I mean, if you're talking about losses on these loans, again, the banks are being very cautious, and you also want to take into account there's not a lot of loan activity, so you cannot also sell a lot of loans. You won't have anything on your books if you're not originating a lot of loans, especially 1 to 4 family loans. The activity there is like non-existent right now. There's no income. It's not just the interest income. It's also banks originate loans and they sell those loans to other non-bank lenders as well. So no interest income coming on those, no non-interest income. So I'd rather still have some yield coming even if it's low. So there are going to be banks that are going to try and sell some of these loans, but not everyone can do it right now because there's not a lot of opportunity out there for new loans.
And if I'd chime in on that question for a minute also, we're going to be talking a little bit about some of the as-reported voluntary. Go skip ahead a couple slides to that Wells one. Yeah. So a number of banks like Zain was talking about for Western Alliance actually disclose information about those maturity walls, and there's been a lot of focus on the office market and some of the concerns there. And I think that I don't have it handy right now, but we could talk offline further about how one of our articles took a look at when those different ones are maturing by year, kind of an aggregate for the large banks that disclose office portfolios, for example. So there is some of that data out there, and I think that the general trend was for some of the smaller banks, it was actually pretty far out, like 2027 and beyond for the office. But there's some voluntary disclosure, but as a whole, it's like not a very standardized subject. It's something that's harder to compare because it's something the banks are just voluntarily disclosing as far as the maturity timelines.
Right. The disclosure is like, the problem is on CRE, most of the problem, I should say. And the breakdown of CRE in the regulatory reports is not as much like Hunter talked about. In the SEC filings, it's not standardized. One bank would include a certain loan in CRE, other would disclose it separately in another category. So we try and standardize those. We put some research out on that as well. We have some data in the product as well as it is reported by banks. And there are certain cases where the SEC has basically asked certain banks to provide more detailed disclosures on their office loans, like Hunter talked about, by maturity and see when are they maturing. So that is definitely under discussion. But a lot of this data for CRE is unfortunately, we don't have that granular level of data. But if you look at the breakdowns that are available, owner-occupied versus non-owner occupied, something that we regularly look at, most of the problems are coming from non-owner occupied CRE loans. Owner occupied is still holding up pretty well.
Yeah, and we can jump back a second here. This is that one of the data dispatches I was just alluding to. It's a little bit hard to read at this Zoom. But basically, our research team summarized a lot of that as reported data on loans and took a look at these are some of the banks that had the most significant criticized office loans portfolio or kind of office loans percentage. And if we go back about 3 slides as well, so to Zain's previous point, yeah, the call report data gets very detailed in a lot of ways, but it just lumps all that commercial real estate basically into just a couple buckets, the owner-occupied, non-owner occupied. So that's where the as-reported data can be beneficial because like Wells Fargo discloses this one is for food and beverage, this one is for an office, this one is for retail, et cetera. But not every bank does that, so it just makes it a very kind of messy process if you're trying to compare that commercial real estate using the SEC data. Yeah, and again, this is showing it, that's the as-reported data, and then the asset quality for that's commercial real estate, multifamily is just going to be those buckets that show 90 days past due, 30 days past due, et cetera. Very, very detailed breakout.
Yeah.
Kind of related to credit quality and the maturity wall. Are you seeing any data that's showing that, like these balloon payments that are coming due, even the ones that have already occurred, are they able to get the financing they need to, meet that maturity, or?
So you're talking from the borrower's perspective, if they're able to get more credit, or?
Also, like the exposure to the banks, if we get that maturity wall and there's some dearth of balloon activity, kind of says everybody's going off on refinancing.
Yeah, definitely.
Down, fingers crossed, but no promises.
Yeah, I mean, if anyone's expecting the rates to come down sharply, I think they're completely in the wrong. I would say right now, my opinion, not S&P's opinion, but it's going to take a while for rates to come down. Refinancing is that activity is going to remain low, but obviously there's a lot of pressure on consumers right now. So you are going to see distressed borrowers with limited access to credit, whether they just don't want to get into high rates or it's the bank tightening lending standards and not willing to lend more. But the consumers themselves have also held up pretty well. Yes, they're feeling pressures. Everybody's feeling pressures from inflation and everything. But if we rewind back to the start of last year, January, before the bank failures, a lot of people were talking about how excess savings are going to run out by the spring of last year. They didn't. People still have excess savings. Their household debt to income is still below the 40-year national average. People were talking about there's a mild recession around the corner. And these are some of the big guys, like Jamie Dimon saying that excess savings are running out, there's a recession, there's a storm around the corner. But that didn't happen. I think the consumers have held up pretty well as well. There are definitely pressures. There is going to be lost content, but so far we have been able to manage that. I hope that answered the question. I hope that answered the question. Okay. And on the failures bit, I would, if you're interested in that sort of data and news, I would definitely keep an eye out for the stress test results that are going to be released today. I'm definitely looking forward to it. For the last few years, the regulators have been saying everything's fine, everything's perfect, but we did have big bank failures last year, so I'm kind of looking forward to what's going to happen in the stress test that will be released today. Probably 3:30ish, I guess. Anyway, I'm gonna quickly go through the next few slides. This is basically transaction volume by different property types. Office, you just focus on the last column there. Property transaction volume has been declining. The valuations are historically low. Even where there were cases in the markets where the number of properties sold were higher than 2022, the property transaction volume was just declining for office. Look at retail, same story there. A lot of activity in the southeast region, but the valuations are low. The transaction volume has been declining. Similar for apartment and the industrial transaction volume as well. This is looking at publicly traded REITs by property type and their premium or discount to net asset value. You can see office right there at the bottom, obviously struggling for quite some time. Hotels down there as well. I kind of thought hotels would have done better since the pandemic, but they are still struggling as well. CRE loans, again, just quickly gonna go over this. The CRE delinquencies, we talked about 90 days past dues, 30 to 89 past dues. The delinquencies have been rising quite a bit. But you also want to dive into to see where the problems are coming from, which bucket of those CRE loans. For example, construction and development loans have the delinquencies in those have held up pretty well. Now, if you compare like quarter over quarter or year over year data, you're going to see like, oh, there was a 5% jump, there was a 10% jump, there was a 15% jump. That's coming off a very low base. So you can't just look at those percentage increases because the asset quality was kind of non-existent. Asset quality issues, I should say, they were kind of non-existent. It was at historically low levels. So instead of looking at the percentage increases or the dollar amount increases, you need to go back historically and see what it was like in 2007, 8, and 9. Right now, in a lot of these buckets, when I look at the data, we are somewhere at the start of 2007. So I believe the next couple of quarters are going to be crucial, and that's going to tell us where we are heading. Is it going to be anywhere closer to what we saw in GFC, or is it going to be something completely different? We remain in the camp, like I mentioned earlier as well, that it's not going to be something that we saw in GFC. That leads us to our projections on credit quality. Net charge-offs, they more than doubled in 2023 compared to 22 levels. And with all the pressures that we are seeing on CRE and the consumers are facing as well, we are going to continue to see net charge-offs increase in 2024, and they're going to peak in 2025 before coming back down in 26. And that would be the end of a credit cycle if things don't go really bad or really down south from here. But again, the hit to the income statement is going to be manageable, and it's not going to be like a safety and soundness issue, at least at this point. M&A activity has been non-existent as well. Obviously, rates are high. Valuations are low. Not a lot of sellers out there at times, or when there are sellers out there, there are not a lot of buyers out there. So a lot of issues there, a lot of new regulations as well. FDIC came up with one of those proposals where they're requiring banks to add more details on their applications like details related to their CRA plans, their branch expansions, branch consolidation, and then they're trying to be more transparent to the public. So if the application gets rejected or withdrawn, it's going to be made public. So it may end up discouraging some banks even to even pursue M&A. So hopefully that won't happen. There are a lot of delays as well. You're going to see the regulators take their time, do their due diligence. In a lot of cases, or not a lot of, in a handful of cases recently, we have seen the regulators ask these banks to increase their capital levels if they want to go through with that deal, especially in the cases where we had this deal between Home Street and First Sun at the start of this year. Home Street had a one-handle NIM, and it continuously appears in our high CRE exposure stories as well. So that deal recently got amended with the regulators asking for more capital in that deal. So you're going to see a lot of those. Definitely the regulators are going to be open for these deals as well. They also don't want to take losses at the end. Obviously, when the bank fails, they have to end up absorbing some of those losses, but they're going to try and make sure they're not creating a long-term problem by letting two banks merge. Everything put into our earnings projections, net interest margin for the industry, we are projecting a 3 basis point drop in 2024 before it climbs back up in 2025. This is, again, as of March. It may change when we put out the new projections. And earnings, we are going to continue to face pressure. You see something here called excluding bargain purchase gains. I do want to mention that while the industry is struggling, we are also kind of struggling with projections because a lot of these one-off items you can't really forecast or predict. You're going to have these big banks buy failed institutions, and they're going to have like big bargain purchase gains, which are like one-off items in your income statement. So that is skewing your data. Then you're going to have things like goodwill impairment charges. We're going to have a lot of those last year. We saw a lot of those last year. And then special assessment fee, if you're aware, like banks had to pay a special assessment fee for those failed banks. JPM had a $3 billion charge in their income statement at the end of the fourth quarter. So things like that, these are difficult to forecast. So we try and exclude those one-off items wherever we can. Community banks, we continue to see pressure on NIM. In Q1, we saw a 16 basis point drop in margin for community banks. So a lot of pressure there. We continue to expect pressures in 24 before they pick back up in 2025. And same is the case on the earnings side for community banks as well. Your margins are under pressure because of high cost of funds, and then the credit costs are going to cause a headwind to the earnings. Wrapping everything up, I think we are over time, but yeah, definitely liquidity still as a focus. CREs in the spotlight. Regulatory exams for the banks are going to get stricter and stricter, and many banks in the second half of the year are going to try and look for synergies, efficiencies, and that is going to basically push them to potential M&A. And that is all I have for today. Any questions? Yeah.
Someone who has a bunch of thrift conversions where you really hope M&A is the only thing. Can you just dig a little bit more into that stock that you talked about? Is it the concerns about, the acquiring bank's own balance sheet, or is it, hey, we have to have this thing and recognize everything? I'm asking you to kind of qualify.
On the M&A slide?
On the M&A side, you talked about
Yes.
for more M&A.
Yeah, so obviously right now the valuations are low. So banks are not willing to sell because they feel like their bank's doing better than they're getting paid for. So you're not going to get a lot of premium on those deals. So that's one issue. The other issue is, like you said, you don't want to take somebody else's problems right now. Some banks that are in trouble, they're going to try and find a buyer, but everybody know that they don't want extra scrutiny. Like the First Sun and Home Street, I think, is one of the best examples I can share because they announced the deal thinking, all right, that's going to go through. But now the regulators come in and they're like, you need more capital because they have more CRE exposure. So the securities are deeply underwater. I think a lot of banks are going to wait until there is a rate cut, so that eases some pressure, and then they're going to get into more M&A activity.
And maybe a corollary to that, given the valuations, do you guys have any data on like cumulative share repurchases? Because we saw a lot of repurchases. There are the haves and have-nots. There was Silicon Valley Bank, right? Because you can see a lot of insider trading versus and share repurchase programs.
Yes.
Yeah. Any commentary on that?
Yeah, we do have that data, but I don't have any slides here. I can definitely.
Going up or flat?
I think share repurchases, again, it's going to be a limited activity, especially for the bigger banks after the stress test release. I think that is what the regulators are going to restrict them on. Very limited activity on buybacks.
And finally, you guys also, thank you. You also have a great podcast.
Oh, yeah.
You got to rep that a little bit.
That's true. Yeah, that's your manager, right? Nathan Stovall,
Yeah.
Street Talk. You can look it up on Spotify, learn about trends in the banking space. He interviews sometimes CEOs of some of the successful community banks at our conference the other time. That was an interesting episode. So thanks for the shout out.
Yeah, he's my boss. A lot of this is basically him and me. So, yeah.
A little earlier about Basel III endgame, and I know you guys do some work on trying to forecast future bank profitability. How sensitive do you think that profitability is to wherever those regulations end up landing? I mean, certainly what they showed us back in July of last year looked pretty punitive. Do you guys have a view on where you think the regulations are going to land and what the ultimate impact on?
Yeah.
Particularly for GSIBs and banks that are trading counterparties for people.
Right. Yeah. I think we're in the camp with where the banks are at this point, because there's going to be an eventual cost, a very high cost that banks are going to try and pass on to the consumers. And that's what they said in the campaigns as well. Basel III Endgame is going to increase the cost to the end consumer, because banks are not, all these regulations, if you look at big banks, eventually they find a way to pass that cost on to somebody, right? So definitely there's going to be a capital hit for sure, but it's going to be it's going to be significantly lower than what it was in the initial proposal. I think the initial proposal for the large banks required a 16% increase in capital. What the Fed has pitched, and these are rumors, I haven't seen the document, I just read a story on Bloomberg, that the revised version that the Fed has pitched to the other agencies require an increase in capital of just 5%. It's not even half of what they originally proposed, but definitely going to have an impact. And like I said, TCE, and there's a lot of indirect impact as well, because your unrealized losses, if they start flowing through regulatory capital for everybody above 100 billion, right now it's just the GSIBs. If it's everybody 100 billion, they're going to be focused on maintaining those capital ratios. They're not going to be able to benefit from high yields out there. There's going to be a slowdown in lending activity. So these are the kind of things we do try and include in our projections wherever we have some hard data. Otherwise, we are not, like, our projections are not like completely a result of statistics or running regressions and everything. We do that, but at the end, we also have a gut check. Does that make sense? We look at data historically, we look at 15, 20 years of data, and then we try and account for these things. All right, CECL, how do you account for CECL when it came in 2020 and 2023 for other banks? So we tried to incorporate all of that stuff in our model, and eventually we see like what the street is projecting, whether that makes sense or not, and then we try and change our models, because the way that things have changed over the last couple of years, a lot of pre-built models have broken down because the rates went up so fast, the yields, the cost of deposits, deposit beta, the industry has not seen that in the past. So you have to rethink your models, and you have to tweak those models to account for these changes that we've seen over the last couple of years.
I think Tyson, you had a question also?
Yeah, I guess I was just curious, what are your thoughts on the credit unions purchase of banks? Is that a trend that's going to continue at this pace?
Yeah, I'm actually working on a story on that topic right now. Very interesting. Banks hate credit unions. That is something that we continue to hear from the banks because obviously they're not
taxes.
for-profit organizations, the taxes, all that stuff. We have seen a lot of credit unions starting to acquire banks, and I've recently started looking into. Hopefully, in a couple of weeks, I'll put out a story. Are they really benefiting from those acquisitions eventually? What I'm seeing right now in my initial research is these credit unions that are buying banks, they're kind of, it seems like we're still working on it. It seems like they're kind of getting stuck with some of these customers that the banks had with high cost of deposits. So their margins are coming under pressure as well. So I'm looking at the credit unions that have acquired banks, comparing it to the rest of the industry, and their margins are under pressure. So they're getting stuck with those CDs that those bank customers had, and now they're going to have to continue to offer high CDs. And if they do it to the customers that the bank had, they have to do it for their own customers as well. So they're going to increase, that's going to increase their cost of fund. Banks really hate it, And credit unions, we are going to continue to see it. We have seen a lot of those recently. And I think in the first quarter, we probably saw more of these than the bank deals. So
I think there was an article saying that we were responsible for like 25% of the mergers in the last year. Because we didn't have any other activity in the banking space. And credit unions are basically taking advantage of these tax benefits, and they're acquiring banks. And there are instances where they're not able to buy a bank because certain states have laws where a credit union cannot buy a bank. There are instances where credit unions, if they're not able to acquire a whole bank, they're acquiring branches of those banks. And even to the extent in some cases where they're acquiring talent. So I've heard of cases where certain credit unions are acquiring full lending teams from banks to get more business. I think credit unions, it's a very interesting space, and it has been for a while. If you guys know the history, prior to 2012, credit unions did not have a very big market share because a lot of credit unions did not know that they could do business with non-members. They thought they could do business only with the members. But there was a guidance in 2008 that NCUA put out that low-income designated credit unions can do business with non-members. And in 2012, the NCUA sent out letters to those credit unions. They were like, all right, you don't have to do the calculations. We'll do it for you. You can do business with non-members. And if you start increasing, if you see their share since 2012, credit unions have increased their share by quite a lot since 2012. And they're continuing to do that. And this acquiring banks stuff is just going to continue to give them more advantage, I think. But I also feel like, and I hope that they're doing their due diligence. They're looking at things like whether acquiring these banks makes sense also, or if it's going to create a long-term problem for them, just like I talked about something that I'm looking into, like their cost of funds is going to go high because they're going to try and avoid a customer fallout by offering high rates that they're not used to offering.
We're a few minutes over, so you probably better go ahead and put a pin in it now. But happy to chat with anybody else offline, and thanks for the opportunity.
Yeah, I'll be here for you.